What's up everybody, my name is Lili Thompson and welcome back to video number 2 in our series on real estate terminology. If you missed part 1, we went over 10 basic terms and you can check out that video here. Today I've got 8 more terms for you and we're going to start off with ROI. ROI is a common acronym that stands for return on investment and it's usually expressed as a percentage. What the ROI tells you is what percentage of your money that you're going to make back based on how much you put out to buy the property. You find it by taking your monthly cash flow, multiplying that by 12 so you know how much money you made in a year, and then you divide that number by the amount of money you spent to get the property. So let's say you decided to buy a duplex that you were going to house hack for $100,000, and because you were using an FHA loan, you put down 3.5%. Well, imagine that you live in one side of the duplex and you rent out the other side of the duplex for $1,000, and after expenses and everything is paid for, you cash flow $50 a month. You would then take that amount of $50 and multiply it by 12, showing that you made $600 in that year. Then you take $600 and divide it by the initial amount of money you needed to buy this property, which was your $3,500 for a down payment, which equals about 17%. And so in year 1, you were able to make a 17% return on the initial investment you made to buy the property. Term number 2, ARV. This is another acronym and it stands for the after repair value. This is when investors make an estimate of what a property will be worth after they fixed it up and repaired it. It's very commonly used when an investor plans to wholesale or flip a property, both terms that we'll talk about soon. Term number 3, appraisal. While an investor estimates the ARV before they rehab a property, the appraisal is the actual assessment of how much that fixed up property is worth. Appraisals are performed by licensed professionals who take into account many different factors to figure out what a property is worth. They'll look at things like the location, the age of the house, the types of materials that are used in the house, such as what types of floors does it have, what types of countertops. They'll also look at the general wear and tear of the house, as well as something called comparables or comps. Comps or comparables are properties of similar size that the appraiser can use to compare your property versus others. Using comparables gives the appraiser a good estimate of what things are worth in that area, because if there was a very similar house that was sold down the street for, let's say, $150,000, they probably won't assess the one they're looking at right now for $300,000 unless it is astronomically better than that comparable. Term number 5, closing costs. These are costs that are associated whenever you finish or close a real estate transaction. They can include things like the amount the bank paid to get an appraisal done on the property, which is then a cost that they can pass on to you. They also include fees to pull your credit report, as well as other fees that the bank associates with closing the loan for you. I've heard a ton of experienced investors say that these closing costs can be negotiable, and so if you get a quote from different banks, you may be able to get them to compete against each other for your business and scratch out some of those closing costs that they might normally charge. Term number 6, prepaids. Now, one of the things that I was most confused about when I first started looking into real estate investing was the difference between closing costs and prepaids. While they're paid at the same time, closing costs are the fees that the bank charges to actually close the deal, and prepaids are costs that you would normally pay as a homeowner, but the bank charges you for them up front. So you might have to pay the first couple of months of things like your home insurance policy, property taxes, or your mortgage insurance, which is actually part of our next term, PMI. PMI stands for private mortgage insurance, and it's usually charged whenever you put less than a 20% down payment on a house. It's about 1 to 2% of the loan. It's charged every single month and it's added to your normal mortgage payment. The reasons that banks charge mortgage insurance is because if you put down a low down payment, less than 20%, then that means the bank is loaning you more money. Because of that, they want to be protected against you not paying that loan, and so they charge a small extra amount every single month in the form of insurance to protect themselves. And our last term for part 2 of this series is hard money lender. A hard money lender is usually a private individual or company who loans money most times on a short-term basis. So if a bank will give you a mortgage for 15 to 30 years, a hard money lender will usually give you a loan for anywhere between 6 months to 18 months. Because these short-term loans are more risky than long-term loans, they charge a much higher interest rate. And so while interest rates from a bank are around 3 to 4% over the course of 15 or 30 years, for a short-term loan from a hard money lender, you can be looking charging at anywhere between 10 and 20% interest. All right, guys, I hope you found part 2 of this series helpful, and if you did, please like this video and subscribe to the channel. Next up in the series is part 3, where we're gonna break down the definitions for certain strategies such as buy and hold, house hacking, wholesaling, wholetailing, and rental arbitrage. Make sure you subscribe so you don't miss it.